These two little words on your mortgage could cost you or save you thousands of dollars. Mortgage points. You might hear your mortgage lender talk about points. You may even see them on your paperwork without fully understanding what they are or whether you should pay for them. So what are points, and are they a good deal? Mortgage points, also called loan discount points, are an upfront fee you can pay at closing to lower your interest rate. Each point costs you 1% of your loan amount. For example, on a $300,000 loan, 1 point would cost about $3,000. So why would someone voluntarily pay more? Because your lender gives you a lower interest rate, which reduces your monthly payment. The exact amount varies by lender and market conditions, but generally 1 point lowers your rate by about 1/4%. So, if your original rate is 6.75%, paying 1 point might bring it down to around 6.5%. That may not sound like much, but it can lead to a significant savings over time. As an example, it would save you $50 per month on a $300,000 loan. Over 10 years, that's $6,000, double the $3,000 invested. But then again, 10 years is a long time. So, should you buy points? Buying points is not automatically a good or a bad idea. It depends on your goals, your budget, and how long you plan to keep the loan. Points make sense if you plan to stay in the home long enough to break even, you have extra cash or a seller credit available at closing, or you need a lower monthly payment to qualify. Points are less ideal if you expect to sell in a few years, you need the cash for repairs, furniture, or moving expenses, or you have a tight budget at closing. If you think rates will drop soon, it's best not to pay points. Remember that points are not refundable. If you refinance in 6 months, you lose that money. To know if points are worth it, calculate how long it takes for monthly savings to equal the upfront cost. For example, if 1 point costs $3,000 and lowers your payment by $50 a month, it would take around 60 months to break even, or 5 years. If you plan to stay in the home longer than that, buying the point could be a smart move. If not, it may be better to skip it. Yes, some mortgage borrowers buy half points, or 1 point, or even multiple points. Lenders usually allow this as long as the final rate does not go below market limits. Just be aware that each additional point often reduces the rate by a smaller amount. Mortgage points are often not beneficial when rates are higher than usual, you're buying a forever home, you want to reduce your payment for long-term affordability, or you have strong savings and you want to invest in a lower rate. Here are some final thoughts. Mortgage points can be a powerful tool to lower your interest rate, but only when used strategically. Understanding the cost, the break-even point, and your long-term plans is the key to making the right decision. Before deciding, talk to your lender, compare scenarios, and run the numbers. For more mortgage insights and cost-saving strategies, visit mortgageresearch.com. If you have any questions, drop them in the comments. We're always glad to help. Thanks so much for watching, and here's to making smart financial choices with your mortgage.